Hello, and welcome to the Crypto Beat. My name is Kelvin Sparks. This is my co-host, Tim Copeland, Head of Growth at The Block. Joining us today, we have Anthony Pompliano, Chairman and CEO of ProCap Financial, and Jeff Park, Chief Investment Officer of ProCap Financial. Welcome to the show. How are we all doing?
Doing good.
Doing great. Thanks for having us.
And before we begin, a disclaimer, since we are chatting with two investors, nothing we say on this podcast is investment advice, financial advice. Make sure to always do your own research. In today's episode, we'll be talking about Bitcoin's identity crisis. Now, Pomp, before we jump in, I did want to ask you more so about ProCap. And when you set out to build ProCap at the end of 2025, you talked about the retail investor being underestimated and viewed as a second-class citizen in the market. So what were some of the experiences that made you realize that something had to change?
Well, I think that historically there's been institutions and there's been retail, and the institutions are self-explanatory. The retail investor was seen as dumb money. They didn't have a lot of money, and they were pretty much just boxed out. With the rise of platforms like Coinbase and Robinhood and various other fintechs, I think that we started to see those retail investors get access to the market, but they were still considered relatively dumb money and relatively not high income. What we've seen, though, is now there is a rising middle class or upper middle class in the investment world. I call them an independent investor. And the way that I identify these people is they basically have three specific components. The first is they get their information online. So they get it through X or Reddit, podcast, YouTube, newsletters, etc. And that allows them to think independently. They are not getting force-fed the information from the mainstream media or the academic economists. And so by thinking independently, that puts them kind of in a different mindset. The second thing is that they want to directly manage their own capital. They do not trust financial advisors or RIAs. They would like to take their capital, access the market directly, and then go and make decisions and live or die with the results. And so they're using some of those fintech platforms, but some of them are also using, the interactive brokers, E-Trade, et cetera. Just they do not want to hand their money to somebody else to manage it. And then lastly is they are chasing financial independence, and they understand that they may not leave their W-2 job, but they're not going to get to the financial security and independence that they desire by only getting the salary. And so they look at managing their own assets as a way to achieve their goal. And so they think independently, they act independently, and they're chasing financial independence. Now, what's interesting about that crowd is they are digital natives, and they are very, very high net worth for an individual. We have a lot of data now that suggests just the audience that I've collected online, the average person has a multi-million-dollar net worth. And of course, when you go and you look at that, there's some people who have, a couple $100,000. There's some people who have hundreds of millions or, billion plus dollars. And what's interesting to me is that all of the major financial institutions are trying to service this group. You'll hear on their earnings calls them talking about the retail investor, the private wealth channel, the self-directed investor, et cetera. But the problem is that these large financial institutions are set up to distribute their products via RIAs and wirehouses, right? And when you go and you put products in those channels, you cannot reach these people. These people are not working with the RIAs. They are not clients of these wirehouses. Instead, you have to distribute these products online directly in a B2C type manner. And so the legacy firms are just not set up to do that for a number of different reasons. I think that will change over time, but I do see an opportunity to build a financial organization that has the right products and services that is distributed in a digital native way to a cohort of folks that are much wealthier than people realize. They're much more sophisticated than people realize, but they're all are collectively bought into what I call kind of the Bitcoiner mindset. So yes, they own Bitcoin, but they also own other assets, and they generally are taking this independent approach. And so I think that, that is the opportunity that's in front of us.
Understood. And now to shift it almost to an institutional perspective on the topic of Bitcoin, why all of a sudden are all these institutions wanting the optionality to exit the fiat system?
I don't think that they're exiting the fiat system. I think they're trying to pull Bitcoin into the fiat system. And it's very simple. Like, they understand if they do things with Bitcoin, it will bring them more clients, more revenue, and more profits. And so anytime that they can get more clients and more assets, which just leads to that revenue and profit, they're incentivized to go there. They need to grow. And if you look at the legacy system, there has not been a ton of, material growth in these financial organizations unless they've expanded to either new cohorts of users or they have embraced new assets. And I think that's why you see them very excited about Bitcoin, tokenization, prediction markets, all these various assets, is because they understand young people are there. They understand there's a lot of wealth creation. Think of Bitcoin in the last 15 years, went from zero to a couple $1 trillion of market cap. Well, where does that wealth go sit? every single major bank or financial institution would love for that wealth to migrate its way into one of their products or services. And so I think that it's just an incentive for them to go and embrace this stuff. And rather than them leave the legacy system, they don't want to ruin their existing business. They simply want to pull the new asset into that kind of regulated environment. And I think that's what you see them doing.
And Jeff, when you joined ProCap, you said the world hasn't yet witnessed what a true purpose-built, Bitcoin-native financial institution designed from the ground up to maximize shareholder value can truly look like. I guess my question here is is that what Bitcoin is about these days, maximizing shareholder value?
Yeah, as Pomp said, I think there's a key correlation between those who come from an independent investor mindset and being a Bitcoiner. So what I mean by that is it may be that not all independent investors are Bitcoiners, but I can assure you that almost all Bitcoiners are independent investors. And so in that world, you have to start thinking about how to service those investors for the benefit of ways in which the whole landscape of financial services is changing very rapidly. When you think about how Morgan Stanley is going into the business of offering crypto as a mainstream asset class in all the ways it's touching their business, not just offering the spot Bitcoin ETF that they've announced, but also thinking through tokenization, how to actually offer those exposures through their E-Trade platform, how to grow wealth management more broadly. We're really talking about Bitcoin serving as a signal for wealth creation amongst a new generation of investors who like to do things in a specific way. As Pomp said, they're digitally native. They're a little bit cynical about having intermediation where they lose agency of their own independent decision-making power. And three, they're quite wealthy from having been tech forward and wanting to embrace that kind of change and volatility. So when we think about shareholder value in the context of ProCap Financial, what we're really imagining is Bitcoin is, yes, a financial asset, but it's also a social asset for which there's a lot of synergy that can be created, where some of the biggest fundamental cost centers of any business building is actually customer acquisition. And customer acquisition in Bitcoin world, because of the ideals and virtues of how you're positioned, can actually be incredibly accretive if you're able to do it the right way. And I think we believe that it's a wedge to really think about the way retail and independent investors are approaching the RIA channels differently going forward.
Understood. And one thing I'm curious about now as we zoom out now, talk about crypto more broadly, is the chasm between Bitcoin and altcoins. Why is it so broad in your opinion? And has the altcoin bubble popped?
Well, I think the chasm is broad because there is a lot of other things that are really, really exciting that is competing for capital in a way that wasn't historically the case in 2020. And it wasn't the case, I would almost argue, back in even the 2017 cycle, because there's a lot of big things that have happened. One, the general financial services industry has morphed towards being a little bit more liberal towards offering retail investors access to things that they historically did not. For example, there's lots of kind of financialized ways to invest in asset classes with leverage that historically wasn't available before. We now have the rise of predictions markets, which is allowing a different kind of investing that historically was not possible before. And so when you think about all these mega trends that are happening, there's just a lot more things that retail investors can do for wealth creation beyond just speculating on altcoins. I also think it's possible that the altcoin universe in general is one where there's just a lot of dispersion and there's a lot of noise to figure out actually kind of what are the right places to invest in. And it's still very nascent in ways where Bitcoin, I think, is separate from the altcoin complex for the energy it leads because of the thesis fundamentally being slightly different than a fintech play, which is basically what, the broad category of altcoins might represent. Bitcoin is a store of value. I don't think people are investing in Bitcoin as a fintech play. And so when you broaden that universe to fintech, there's just a lot of other exciting things that are happening, especially in the construct of how agentic investing and AI has been introduced as well to give people a lot of agency in ways that historically didn't exist before.
Just between the sort of scarcity focus for Bitcoin versus all other assets, which sort of the opposite of scarcity, you're sort of seeing supplies of tokens in the millions thanks to Pump.fun and more launchpad platforms. Pomp, what do you think is the biggest risk to Bitcoin these days?
Well, I think that there's different risks at different parts of Bitcoin. One of the things that I think people are still trying to wrap their heads around on a technical side is how to think about quantum. It's been a technology that people have talked about for a long time. I think that Bitcoiners have decent answers. for what they will do or how they will mitigate that risk. But I still think for the average person, when they hear quantum and they think Bitcoin, there's still some questions in their mind. And so I think that's an area of improvement for myself and for everyone, is how do we answer that question? But I think that's a risk in the eye of the average person. In terms of the community around Bitcoin, I think that there is quite a bit of disagreement, which historically has been a very strong, positive aspect of Bitcoin. Is it was kind of this meritocracy, and whoever had the best idea it won out, and that was what was implemented. I do think that when you get into the institutional world, they don't like to see lots of disagreement. Their entire world is governed by consensus. They have consensus being determined at their investment committees. They like to be seen as always being politically correct, etc. And so when you see the Bitcoiners doing what Bitcoiners do, which I think as a Bitcoiner you say, hey, this is really, really valuable for the protocol and the asset. I do think that there is this risk that the institutional folks are like, oh, wait a second, you guys don't agree on all this. There's potentially some issues there. And then lastly, I think that from an economic standpoint, right now, deflation to me is a much bigger risk in the economy than inflation. And if you go back for the last year or so, I've been very loud and fairly stubborn about the fact that tariffs were going to be deflationary, not inflationary. I think that in hindsight, not only was that correct, but we also have seen the rise of AI at a pace and kind of a breadth that we didn't really expect. And that's been highly deflationary as well. If you add in, even with the tariffs, even with the weakening dollar, even with deregulation and tax cuts, et cetera, we are seeing inflation come down in the United States. And so that deflationary or disinflationary mechanism is worth paying attention to, because I think historically people looked at gold and Bitcoin as potential inflation hedges. And so if you go back in 2020, both Paul Tudor Jones and Stanley Druckenmiller came out. They said, I am buying Bitcoin, I'm buying gold. I think inflation is coming. I just happen to think Bitcoin will be the fastest horse, was kind of like the famous quote. Now, if you go and you look, Bitcoin has not done well over the last year or so compared to many of the precious metals. And I think a very big reason for that is people do not perceive there to be as much forward inflation as people maybe were reading about in the media. Now, there's a lot of folks who will point to gold and say, well, gold's the counterexample. Why is gold going up but Bitcoin's not? And when you actually look at who the buyers of gold are, it's central banks. But I don't think that central banks are buying gold because they are trying to insulate themselves from some future inflation. I think that the central banks are buying it, and they're saying it because they are not only de-dollarizing, but they are actually reducing their entire exposure to fiat currencies. And so they are not, selling dollars and buying yen, won, pesos, euros, et cetera. They instead are getting rid of fiat currencies and converting that economic value to gold. And so I think that there's a bid in the market for gold as part of this like de-fiat currency process. And so that would, reinforce this idea that maybe one of the reasons that Bitcoin is not performing nearly as well over the last really 6 months is because in the first half of 2025, people perceived that there could be a risk of inflation. And so Bitcoin ran along with gold and other assets. Once it became clear that that inflation was not going to show up, gold continued, but again, it's coming from that central bank demand. But Bitcoin then kind of rolled over and has since come down. And what you've seen is that Bitcoin's rollover actually preceded what we're now seeing in the government's inflation numbers. I don't think the government is correct in their numbers, but I do look at things like Trueflation, which has seen inflation fall from 3% at the start of 2025, now is reading below 1.2%, kind of a year to 13 months later. And so I just think that this idea of Bitcoin being a great inflation hedge was one of the key pieces as to why people were buying it. It's not the only reason, but it is one of the key ones. And so if we do not get high inflation for the foreseeable future, then I think that could be a headwind for Bitcoin as well.
What do you think of the dollar losing value these days? Like, do you think that has much of an impact?
Well, I think it's part of their plan. And, one of the things that I recently wrote about is if you were to sum up this administration's economic plan, whether you agree with it or not, whether you like the people or you don't, try to be as sober as I can looking at what are they actually doing? And you can pretty much sum it up into 4 pieces. The first is that they want to leverage tariffs to drive revenue. They want to use a weakened currency to offset the impact of those tariffs. They then want to go and use deregulation and tax cuts to spur growth. And they believe that there should be these tech innovations like AI that are going to use a deflationary force into the economy and end up with a high growth, low inflation, economic environment. Whether that happens or not, let's see. So far, it looks like they're edging closer to that. I also think that it explains why when people were evaluating tariffs in a silo, they thought that it was going to be this really inflationary thing. But when you look at it on a holistic basis, it now is pretty clear why prices actually have not surged higher like they thought they would. But when I go and I take a look at the weakening currency, I think that probably the single best thing that somebody can do is to go and read the piece that Stephen Myron wrote. When he was an advisor to Hudson Bay, he put out this piece. It is called A User's Guide to, creating a new global trading system or something like that. And in that piece, on the very first page, he basically writes why you need a weak US dollar. And he talks about offsetting the impact of tariffs, but also about this idea of the trade deficit is linked to an overvaluation of the US dollar. And so I think that when you hear the president say, the dollar losing value is great, look at all the business we're doing. These comments really are reinforcing and confirming for the global investment community that this is part of the plan. They want a weaker dollar. They want to spur economic growth. And so if that is the case, then you're going to see the dollar continue to sell off. You're going to see asset prices continue to go higher. And they are going to measure the success of the U.S. economy based on this framework of high GDP growth and low inflation. And so, let's see what happens. But I think that's really what their economic plan is and kind of why they're headed in the direction that they are.
And I guess on the topic of deflation, AI has been known to be deflationary. And with that, there's also some problems that are occurring within, I guess, the social fabric of society as this changes. Jeff, you've been pretty loud on the timeline about, I guess, some of the benefits, but also perils of AI. Curious if you could get into some of the Occupy AI comments that you'd made and maybe some of the implications.
Banger.
Yeah, absolutely. Look, listen, the reality is when we talk about inflation, there's actually multiple components that build up to what we think about inflation, right? Because in the end, there's two things happening here, right? One, as Pomp touched upon, is the actual price in which you measure inflation, which is the currency. And then the second is the rate of that nominal growth rate over a long period of time. What I mean to say is actually the FX matters just as much as the yield curve matters when we talk about inflation. And I think sometimes what we're hitting upon this kind of fulcrum about why Bitcoin isn't performing the way we're expecting it to is because when you deconstruct that concept of inflation, that's where maybe it's possible to imagine Bitcoin is really more of like a yield play in terms of like the liquidity and duration transformation that we expect for what young people want to have in their future, right? So like when gold is working and silver and precious metals are all working, it's because the dollar is weakening. Like that's pretty clear. But for Bitcoin to work, it's not just that the dollar has to weaken, it's additive. But I think the bigger component is you actually need to have the yield curve come into play and drive a meaningful signal. And I've always said the problem with the yield curve with Bitcoin is there's an environment where low yield can be good for Bitcoin, but there's also an environment where a very high yield can be good for Bitcoin, right? Because one, it's a very optimistic scenario of continual deflation by the productivity gains of AI. But the other one is actually the world's implosion because things are so bad that the dollar hegemony is at risk and the whole system falls apart, interest rates spike, and Bitcoin becomes the safe haven, right? There's this kind of duality of Bitcoin that lives with this particular row risk, as it's called in the Greeks, that makes it really fascinating. And I think part of why Bitcoin is stuck is because it can't make up its mind. What do we want interest rate to do in a way that's proactively good for Bitcoin? And so coming back to the AI thing, I think AI literally represents that core tension too, because when we talk about deflation, there's actually two kinds of deflation as well. There's good deflation, which is the deflation that comes from productivity gains that's allowing cheaper servicing, cheaper products that can be offered, which is actually a net positive for society. If things are cheaper, it's good for you. But then there's also a bad kind of deflation. And that bad kind of deflation is actually further out the curve when you have credit risks and credit contagion, because the whole system of liquidity is built upon this forward curve in which the yield curve should actually never, ever, ever be in backwardation. That puts the whole financial plumbing at risk. And so what AI represents is like this strange thing where, one, it can be really good for people because if things get cheaper, life is great. But if it actually implodes and breaks the whole social contract apart, well, then it's really, really bad. And what you see today is actually a friction between those two things. Take, for example, today, Amazon laid off another 16,000 workers. I believe that now puts the total count above 30,000 in under a year. And Amazon's having, one of the most productive gains you could ever imagine for a US company. To think that layoffs would not be the thing that should be concerning, but it is. And they specifically cite there's just no need for kind of bureaucratic administrative management, especially when they want to double down on things like AI. It's literally in the language of how they're explaining the layoff. And so this Occupy AI that I think about is a bit of a social revolution in which the K-shaped economy as we're experiencing it is literally because there's asset inflation and asset kind of wealth creation because companies like Amazon are doing really well, but they're also firing people. And at some point, like, what is that social contract between business and government and civilians as to promoting good technology adoption for productive cases? That's also like not breaking apart that social fabric and that social contract. And so Bitcoin and AI, I think, are quite related. They both represent kind of the same tension, but just on different sides of the coin as to the opportunity that it can represent. AI, for example, you have no way of investing it today. One of the pet peeves I have with AI today is that there's a bunch of private companies raising huge amounts of monies and incredible valuations, but they literally cannot give retail investors a chance to access that wealth creation together. Meanwhile, they're of course building all those models based on the back of every retail participation in the languages that they're being trained on. Flip the other side. Bitcoin's the other way. It's been incredibly democratic and decentralized in the wealth creation that it can happen on the back of just having free access. And I think those two things kind of speak to a friction that is arising where they're trying to solve the big problem about this particular kind of social upheaval to come.
Slightly push back on something you just said. As this AI is going to enable the marginal cost of software to go to zero, it seems like it's actually easier to start up that thing, to vibe code whatever it is you were curious about, or maybe didn't even have the skills to do. But I guess with that, you kind of have this, how would I put it? Like, just one moment, please. Sorry. What was I going to say? Never mind. I think it was, it was being bullish on self-determination. I think that directly aligns with one of the things that you talk about. If you think AI is going to kill A, B, C, D, E, you're thinking about the future wrong. So, I mean, these things don't seem like they can coexist, or maybe what advice should people take in mind when they're trying to think about investing, surviving, or thinking about their careers in the future?
Yeah, no, they absolutely can coexist. I think that's the one thing Bitcoiners and AIs actually have in common, which is the thing about like how AI toolings become widely available and people are kind of playing in that sandbox and sharing online. It reminds me a lot of the early days of crypto when people were basically learning how to use different crypto rails and being paid for kind of broad social adoption, where you'd had things like learning courses. I think there was one called like Rabbit Hole where you could just do stuff on Web3 and you were getting paid for it. And there's this element of like people wanting to just create value and learning that they think is going to help them develop into the future for what their skills might represent. And I think AI is actually quite similar. Like people kind of playing with Claude, Cowork and Code and Claude bots and all this stuff like represents a little bit of that kind of journey towards self-determination. Now, what I will also say is that, while it looks like it's a broad trend of adoption, the reality is like those things are skills you have to develop then to, I think, use it somewhere else, right? Because a lot of these things, I still believe in that enterprise solutions exist as a software stack for a reason, and it will probably help a lot of the toolings develop much quicker on the back of AI. But I also think it's silly to think that you can vibe code something out of thin air and think that's going to have like permanent value when you're still competing against like really well-resourced enterprises that are trying to solve like really big problems where, many people have always already talked about. People really still care about things like having control over the creative process and how they use their enterprise, right? And I would also argue like the number one job of like a CTO or a chief information officer at any of the Fortune 500 companies is not always just to innovate. It's also liability avoidance, right? Like you actually just work with Salesforce because you don't want to get fired for kind of working with something that you vibe coded and lose customer data. So I think when you think about that stuff, like there's good stuff happening here, which is all about self-determination, but you can't, I don't think, live off of that alone without translating that into like a bigger kind of worthier cause where you're still pooling resources to drive like enterprise level scale of adoption.
Understood. And I guess to segue a bit, because we are nearing the end of time, Pomp, I had a chance to meet some of your former colleagues over the past few weeks, and they had some interesting questions for you. This is around investments. They said, what was your favorite and maybe your best performing investments to start there? And also, Jeff, I'd love to hear your answers as well.
Well, my favorite ones are not necessarily correlated to the best economic performance. I think that there's two buckets. The first is there's things that have like a profound impact on society in general. So if you think about things that have been able to give some sort of economic benefit to people, I'm very passionate about this idea of using capitalism to give people freedom. And so there's a company called Bridget based in New York. They recently were acquired, and they essentially figured out that the top four banks made $8 billion a year by charging overdraft fees. And so, quite literally, the banks were making $8 billion by taking a fee from people who didn't have money in their account. And so, what they figured out is, well, for a $10 a month subscription, we can, in an intelligent way, figure out when you're about to overdraft. We can deposit capital into your account to protect against the overdraft, and we can save you money. And so businesses like that, I think, are really, really interesting. The second thing is there's very big societal issues. I've invested in a number of businesses that are tackling the housing crisis, both in terms of people building physical, structures, things like cover, et cetera. But also we've even started businesses, things like Resi Club, which are going after how do you actually inform people about the problem and identify maybe what the potential solutions could be. And then lastly, on the kind of societal impact, I still fundamentally believe Bitcoin has been the single most important technology of the last 15 years for no other reason than it gave hundreds of millions of people the ability to protect their purchasing power during a period where governments around the world were printing capital and essentially silently stealing the economic value that people had worked hard for. And so there are hundreds, if not thousands of people that I've met over the years who have been able to get their time back because they simply bought an asset and they held it. And so I think that that's, a very positive impact, not only on society, but also on every single one of those people's individual lives. The other bucket that I would say that is always fun are, the things that I put in the cool bucket. And so there's a company that I invested in called Nectome, and they want to figure out how to cryogenically freeze your brain at the end of your life. And then could they somehow preserve the structural integrity and upload everything from the synapse connections, et cetera, into a computer? And so society kind of benefits over time from being able to talk to, an Albert Einstein or whatever. Stuff like that, a little bit more of a science project to start. But, obviously, if there's some sort of breakthrough, it could be pretty impactful. But then there's also things that, have a much shorter kind of commercial runway. And so companies that I see there are things like Rainmaker. They fly precision drones into clouds and they drop off kind of a chemistry mixture that then is allowing them to actually create precipitation and rain at certain times. You can imagine the positive impact for farmers and other areas where that could be helpful. And there's companies like Varda that obviously are launching manufacturing units into space, and they are trying to manufacture pharmaceuticals in space in zero gravity, where you can manufacture certain things you can't do here on Earth, then bring it back down to Earth. And so when you look at these things, I think that there's a through line of how do you actually solve a problem? How do you help somebody? Usually tend to be the ones that I enjoy the most. But I think that we've, as a society, kind of forgotten this idea of the people who are running these companies are really just problem solvers at the end of the day. There is some sort of issue that they have identified that they are passionate about, that they think that there's an economic incentive to capture by solving that problem. And the more that we can remember that they are solving problems, I think the more that society actually encourages people to start companies and try to go after that economic incentive. And the last thing I would say is, take somebody like an Elon Musk. I think that objectively, he is probably the best problem solver in the human race right now in our generation. And so it makes sense that he also happens to be the wealthiest person in our generation. He kind of got the economic reward that is tied to how many problems could he solve at scale. And I think that, that's how the world should work. And hopefully it inspires a lot more people to pick a problem, whether it's in their local community or, on a larger basis, and go out and try to solve it.
Okay, and then what do you think about like for 2026? Do you think we're looking for, an optimistic year in the crypto world, or are you kind of pessimistic? I'm curious to hear your thoughts.
Well, I may not just agree with the premise, right? I don't care what happens in 2026. I don't care what happens in 2027. I don't care what happens in 2028. The way that I really invest and, I've somewhat become infamous for is I like to buy things and almost never sell them. And so what I try to figure out is how to solve the hardest problem in finance. And the hardest problem in finance is how do you transfer wealth from today into the future. You can do that in a variety of different ways, from buying things that don't lose value to buying things that create value. But it is very, very difficult to do over time. And so, if you take Bitcoin as an example, I came to the conclusion a couple of years ago that I simply was going to take the Bitcoin that I own and I'm going to give it to my grandkids. I don't know if it's going to be worth a lot or worth nothing. And both of those outcomes, I guess, could potentially be possible. But there is absolutely nothing that is going to convince me to sell the Bitcoin. And so once you start to think like that, you don't worry about 2026, 27, 28, 29. You're just thinking out over the long run and thinking about what is structurally a tailwind or a positive impact. And then what are the headwinds and things that we have to mitigate. In terms of the stock market and various other assets, I tend to think that the current administration, they are probably more right than they're wrong in their approach to getting to a high growth, low inflation economy. It's not going to be perfect. I think that they at times tend to shoot themselves in the foot in terms of the way that they describe it. But I do think that if we can get into a high growth, low inflation economy, that will be good not only for the country and our ability to create prosperity, but also it is good for the individual, because that means that we should be seeing tech innovation. We should be seeing a positive impact on prices. We should be seeing the ability for real wages to grow. We should be seeing an ability for people to buy homes at a much better rate, et cetera. And so ultimately, I think that there's this famous Peter Lynch quote where he says, if you spend 15 minutes on macro, you spend 13 minutes too much. And I tend to think that now the world actually has shifted a little bit. And the fundamentals of businesses and investments still matter. But I do think that there is much, much more emphasis on policy and macroeconomics and monetary kind of decisions than maybe there was 15, 20 years ago. And so one, it's intellectually stimulating to think about, but also two is I think the current economic policies that are being put in place probably create an environment that'll be very good for investors.
It's a super optimistic note. I couldn't ruin it, unfortunately, since we're running out of time, by asking the back half of your friend's question about your worst investment and your least favorite. So unless you have rapid fire you want to give there.
I love all my children the same.
Oh, very, 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 very PC. I like it. But unfortunately, that's all the time that we have for today. I want to thank Anthony Pompliano and Jeff Park for joining us in this episode. As a reminder, our newsroom works tirelessly to get you accurate, informed crypto news. If you want to stay ahead, read the block. Thank you. See you next time.
Thanks, guys.
Thank you.
Thank you.